Hey, good morning, everyone. Marty Mazzora here, Wednesday, the 1st of November, 2023, with your midweek stock market snapshot. This morning, we'll do what we've been doing of late, which will be me giving you my narrative in terms of kind of how we see the world right now in asset markets, equities in particular, generally the theme of these presentations. And then we'll get deeper into the technicals again of the S&P, the NASDAQ, yields, the 10-year Treasury yield, and then the dollar. After I'm done with this presentation, I'm going to move right into our monthly score of what we call our Equity Market Conditions Index. In there, we look at 12 different variables to get a view of conditions in general, and should a thoughtful long-term investor be significantly engaged or not in the equity market. So we look at things like market sentiment, the technical trends, focus more on the longer term trends in this one, but we do look at the short term, essentially talk about what the short term dynamics portend. We look at overall economic conditions, market breadth, which I'm going to talk about in detail this morning, interest rates and overall liquidity, Fed policy, valuation, geopolitics, credit conditions, the US dollar, sector leadership, and fiscal policy. So it's quite the exercise. We go through these things in detail and formulate assumptions and then score them and then record that, and it'll be something that'll be very instructive to us much longer term. We invented that index back in August of 2021. Okay, so on the topic of breadth this morning, let's first take a look at the screen in front of you, this Bloomberg market breadth screen. And note here on the S&P 500 now, as I speak, it is up 0.5%, so it's having a pretty decent little rally this morning. Note here that 273 of the S&P 500 members are actually in the red. So there's more of the members down than up as I talk at you here this morning. The Dow's up 139 points, so it's up 42 basis points. It's almost 50-50, almost half. 13 of the Dow 30 are actually down on the session. Now the NASDAQ is actually up the most. It's up almost 3/4 of a percentage point, right? 1,800 stocks are down versus, call it 1,000 up. So when we talk about breadth, we talk about to what degree are the boats rising with the tide, and obviously a good solid rally captures the majority of the boats. So we've seen a lot of this of late, right? This just really poor breadth, and people can get really excited, but this just speaks to what we've been harping on, and as other people have, that when you take out a handful of stocks, 7 actually, you have negative results across all the broader averages, and that is just astounding. Does it mean that those 7 are going to catch down and bring the averages down a ton going forward? Of course not. It doesn't mean that necessarily, as the bulls on Wall Street would tell you. It may very well mean that the rest are going to catch up, and we should be buying things like the equal weight index and so forth. And I would be entirely on board with that if I didn't have all the other concerns that have to do with the macro setup that we've been harping on for the last year or so in here. So that's the look today on an up day, and that's consistent with what we've seen on a lot of days. So I'd say the breadth screen that concerns me the most is the one right here, and this is the NASDAQ Composite Index. The NASDAQ index is this, and the NASDAQ 100 is where those magnificent 7 have the highest concentration, right? So here is the price chart. There's the all-time peak, and as you can see, we're still down a fair piece, but we bounced off of this, this October low, October 12th for the S&P, a little before that for the NASDAQ. But this is the advanced decline line. This is cumulative. So every day, this line moves by the number of advancers versus decliners. So obviously when there's more advancers than decliners, it goes up. When there's more decliners than advancers, it goes down. So take a look at the look before the all-time peak, right? We were flagging that then. We were flagging it here in this last big rally off the bottom. And this gets ominous if indeed it plays out where the 7 biggies, drop and catch up to the rest of the index. So suffice it to say, this does not look like a good health checkup for the NASDAQ Composite Index. It doesn't mean that it can't come roaring back. It just means it's not in a really healthy condition as we sit here today. Another really good breadth indicator is simply the S&P 500 equal weight index, which basically gives equal measure to all of the stocks in the S&P 500 versus the cap weighted index, which is dominated by those 7 stocks. And as you can see on a year-to-date basis as of yesterday, the S&P equal weight index, which I think is a good overall broad market index, is actually down, call it 4% on the year, while the S&P 500 is up 9.5%. Now you take, even out of the cap weighted index, you take out those magnificent 7 and you're down here in negative territory. So again, folks, this is not a bull market in stocks. This is a bull market in 7 stocks. Now, speaking of bull markets, again, many on Wall Street have called the October 12th of last year the bottom. It did bottom exactly where we said it would at the beginning of last year, and we said it would be a durable bottom if we didn't have a recession signal flashing. By the time we got there, we did. Therefore, we have to anticipate now a recession. We think there's high odds. And the fact that stocks are not pricing what happens to earnings during recessions, and I know I've talked about that a lot already. So what are some of the characteristics, or what will we be doing when we believe that the bottom is being formed durably? Well, we're going to be buyers of small cap stocks. Why? Because coming out of bear markets, small caps tend to outperform large caps measurably. So here is the bottom, roughly the bottom of the tech bubble disaster. It was a 50% decline for the S&P 500 and 80% decline for the NASDAQ. The white bars are the Russell 2000 small cap index. The blue line is the S&P 500. So you can see small caps just really exploding out of that. And that is very, very typical. Let me go to the end of the next bear market, which was, of course, that devastating great financial crisis of 2008. So ironically, it was around the same time, but in 2009. And here you have small caps really taking off and really exploding out of that. Now, that is very, very typical. We go back historically, and we can find that just, if not every time, certainly a very, very large majority of the time. So 10, 12, 2022 is what many would tell you is the market bottom for the current cycle, right? So we're in a new bull market, right? Well, let's take a look at small caps versus large caps. So off the bottom, small caps and the S&P pretty much moved in tandem, right? And then small caps began giving up the ghost and so forth. So anyway, long story short, we are at bear market lows in small caps. And the S&P is up 17% off the bottom, right? And it's still down for the whole bear market. But this is from the October of last year bottom. So folks, I wrote about this, I believe it was last week, where I said, not so fast on this new bull market narrative. And I could give you data point after data point. But if we just stop with breadth and small caps, we should be highly skeptical that a new bull market has begun, and because of what I think is to come from a macro standpoint, highly skeptical that there's not some more downside in this market. Doesn't mean that there has to be. We're open to all possibilities, but man, it does, for prudent, thoughtful investors, you want to be diversified, you want to have some liquidity, and we think you should be hedging the potential for something ugly in this particular market while being in a position to make money if the market continues to melt higher. So it's just all about general conditions, and it's all about when to take on risk and when not to take on risk. And even though, as I'm going to show you in the technicals, I've been saying last couple of videos, a rally's coming and we're getting that right now, this is not a time to pile in there. So, stay on your toes. If there's a recession, highly likely that there's another leg to this, and that will be the leg that you buy into. Really looking forward to that day, but not getting impatient. I would say this, of course, to clients. We say this to you when we talk, but to anybody else who's watching this who's not a client. If you have a bullish narrative, go for it, right? I'm not telling you not to. I'm not giving you advice. I'm just saying we look deeply at general conditions overall, and while indeed the market may rally from here and maybe the bear market is over, looking at today's data, looking at it in an historical context and thinking critically about the world we live in right now, odds may not be in your favor. Lastly, let me give you a narrative I gave you on here a few weeks ago and I still talk to clients about during review meetings. You've hired us to take you hiking at a very high elevation, and you've always wanted to go there, and everybody you know is having a ball on that mountain. And just before we're about to go, we have it all scheduled, we're all equipped, I call you up and say, folks, we're canceling. Sorry, we just can't go under these conditions. And you're like, what do you mean? The weather's beautiful. Everybody's going. They're having a great time. They're doing really well. What the heck, right? And I say, well, our weather forecast sees a system way out here, let's say to the east, and it's heading our direction. No. That storm was last year. Aren't you watching the news? That storm hit the mountain last year. It's clear. The skies are blue. Yeah, I get it. But nevertheless, let me show you what I'm talking about. This system looks pretty ominous, and it's heading our way, right? We give it 50% odds that it hits the mountain, timing of which would have us way up there at that altitude. And if we get hit by that blizzard, it could be something that really does damage to us for the next few years. So we don't want to do that. We want to remain in the foothills for now. Just take it easy, pick some daisies. And if that blizzard hits, by the way, we're going to get caught in a flash flood to some extent, not like the people up on the mountain. But if we're going to play at all that 50% odds that it doesn't hit, we're going to have to take on some risk, right? And that's okay, because that elevation, that's something we can recover from quickly. And then when there's still a lot of snow on the ground and everybody up there is panicking, we're going to have indications that the worst is over. We're going to snap on our snowshoes, hike up that mountain, and the folks up there are going to be desperate to sell us their very good hiking equipment at pennies on the dollar, because they're going to want to get off that mountain. They're in too much pain to stay there. So then we buy the equipment, we're already up on the mountain, it thaws, and we're in a really good position. Now, what if the blizzard doesn't hit? Well, if the blizzard doesn't hit and our forecast clears, well, then we just start climbing the mountain. And we're not desperate to catch up. We're there for our own purposes, to be smart, good hikers who enjoy the journey. We don't have to catch up to anybody. We don't have to catch up to an index, yada, yada. Yeah, if the blizzard hits, we'll probably have, huge outperformance and we'll be champions on top of the mountain, but that is not what we're trying to do. That's not the purpose. The purpose is to smartly manage money on a smart, thoughtful risk-reward basis, right? Which means we have to work very, very hard at getting our head around general conditions. Now, if the storm doesn't hit, was it a bad idea not to go? I will say unequivocally no, with an exclamation point. We never want to go hiking at a high elevation when there's a 50% chance of a blizzard hitting while we're on that mountain. If we never go hiking under those conditions, we'll never go broke unless we spend all our money, right? And make no mistakes. And long-term clients, you 100% know that we can get very bullish and appropriately aggressive when conditions are very bullish. So this is not anything about our personality or, being pessimists or anything like that. No, this is just truly an objective look at general conditions and making what we think is the most thoughtful assessment and the most thoughtful allocations to our clients' portfolios. Okay, so folks, that was a pretty good bit of rambling. I'll leave it there. So those of you who would rather not stay with me for a few minutes on the technical analysis, this is your exit point. Thank you so much for watching and listening. For the rest of us, here is the S&P 500 daily chart. And again, remember, right here, we were flagging a rally, and look what we got. A really nice 3-day rally that continues this morning against really ugly breadth, as I just showed you. And recall, on the daily chart, we filled that bear flag pattern perfectly, moved back up, about to test the 200-day moving average. Of course, the Fed meets today, or they're finishing their meeting today. That could go one way or the other. The technicals say it could be a pretty good day, could be a pretty good week. We also could be moving right back into a bear flag pattern. And, this rally could have some legs. Seasonality, huge bearishness right now. Lots and lots of people are pessimistic. So if they move to that other side of the boat, like looks like they're maybe doing today, well then we could get some oomph out of this rally. We had positive divergences on our two momentum indicators on the hourly chart, and this is where I really flagged a bullish setup late last week. Very bullish divergences, classic falling wedge, and here you are rallying out of that. We'll see how far this might go. As for the NASDAQ Composite Index, just looking at the daily chart, it's having a really nice move today. The NASDAQ is now up over 1% on the day, so we're breaking out above that. Again, not quite the bullish setup here, but bullish enough to get a nice rally. So we'll see. So much depends on the Fed today and, of course, on the jobs number this Friday. I mentioned yields. Yields are coming down today. The Treasury announced that they're going to be issuing, in this particular auction, less long-term Treasury debt. Market loved that a lot. Came as a surprise. It's not huge, by the way. And again, what did I say? Technicals are pointing to lower yields. That's what's happening today. So we're breaking down below that uptrend line. If that gains momentum, as the momentum indicators say it might, yields come down. That's good news for stocks in the short run, by the way. The dollar index, again, this looks like a very bearish pattern to us, and that would be potentially bullish for stocks as well. It doesn't have to be, but that's how the trading has been of late. Certainly should be bullish for our commodities exposure. Ironically, while yields were dropping for most of this morning up until I turned on the recorder here, the dollar was actually up quite a bit. Right now it's flat. Okay, so the dollar, depending on the condition, tends to move with interest rates. So interest rates go up in the U.S. relative to other currencies, well then it makes the dollar attractive. Interest rates were going down a bunch this morning, and the dollar is flat as a pancake. So that's interesting, if nothing else. Folks, so that was quicker than I normally do on the technical analysis, but yeah, kind of the makings of a rally, and we've seen that now for going on 3 days if it closes higher today. But in about 3 hours, we're going to get something from the Fed that will probably move the market in one direction or the other. There's not going to be a rate increase. There's not going to be a dot plot today. If Chairman Powell sounds like he did a couple of Fridays ago, and says, we're not tight enough, or we're certainly not too tight, and gives that kind of tough, higher forever kind of language, well, then these technicals that are a little bullish here short term, market could actually blow through those in a real negative way. If we got a strong jobs number on Friday, that's the case as well. But, if anything weak, market's going to continue to rally right here. I will leave it there, folks. Thank you so much for watching and listening. There'll be a written note tomorrow, end of week, market snapshot and economic updates. And somewhere along the way, I'll give you the results, usually on the written blog, of our equity market conditions index scoring. Take care. Bye-bye.